All right, here we are. This is chapter 5, part 3. All right, so we're going to start out talking about stock options, okay? And there are two basic types of stock options. You've got incentive stock options and non-qualified stock options, okay? For tax purposes, the tax treatment to the corporation and the employee depends on whether the options are these incentive stock options or whether they are the non-qualified stock options, okay? Now, it's interesting to know, and this has always been a source of amusement for me, these non-qualified stock options, all right? These are more common, okay? So the reason they're called non-qualified stock options is because they don't qualify as incentive stock options, all right? So these non-qualified stock options are much more common, okay? And so you're going to see that their book deduction is the initial estimated fair value of the stock, okay? And then initially, there's no tax deduction until those stock options are exercised, all right? And the book tax difference is unfavorable and temporary, okay? So initially, they get a book deduction, but no tax deduction. So what that does in the year that they are granted gives you an unfavorable temporary difference. Okay, but then later on we'll see these non-qualified stock options in the year of exercise, all right? So the year of exercise means this is when the employee has decided to use the stock options. So maybe I should just briefly talk about what a stock option is. A stock option is a way a corporation can give a benefit to an employee, all right? So a stock option gives you the opportunity to buy stock in the corporation that you're working for a lesser price than market value, okay? So the exercise of that stock option means you're actually using that stock option to buy the stock, okay? So in the year that the employee decides to buy the stock, all right, there is a book deduction of the initial estimated fair value of the stock options, all right? And the tax deduction is this bargain element, okay? And the bargain element is this difference between the fair market value of the stock and the exercise price on the date the employee exercises the stock option. All right, we're going to do an example in the next slide, and so hopefully that'll help. All right, and so this generates a book tax difference that's favorable and temporary, and then so it reverses the unfavorable and temporary difference in the prior years, okay? But then also, depending on the amount of this bargain element, we may have a permanent difference as well, okay? So let's do an example, and I think it'll be more clear. All right, so let's look at our example here, and I'm going to make it a little bit smaller so I can do some writing. All right, so let's look at this problem. So on January 1st of 2024, this company granted 20,000 non-qualified stock options with an estimated value of $10 per option. Okay. All right. Each option entitled the owner to purchase one share of stock for $10 a share. Okay. The options vested at the end of the day on December 31st, 2025. All right. Assume no options were exercised in either 2024 or 2025. What are the book tax differences associated with the non-qualified options in 2024 and 2025? Identify each difference as favorable or unfavorable and permanent or temporary. Okay, so what do we have going on? We have this company who is giving employees stock options. So it's giving the employees the option of buying stock for $10 a share. Okay, the options vested at the end of the day on December 31st, 2025. No options were exercised in 2024 or 2025. Okay. So all right. So according to our stock option rules, when those stock options are granted, whoops. When those stock options are granted, for book purposes, you deduct the value of the option, okay, over the vesting period as compensation expense. So for 2024 and for 2025, they would have in each year $100,000 of a temporary and unfavorable book to tax difference. Okay. Since those shares were not exercised, there's no tax impact to that. So there's a book deduction for compensation expense, and so that drives book income lower than taxable income. Okay. So now look at example 2. All right, so now let's talk about example 2. So this is a continuation of our last scenario. All right. So on March 1st, 2026, the employees exercised all 20,000 options at a time when the stock was trading at $25 a share. So what are their book tax difference associated with the stock options in 2026? And is the difference favorable or unfavorable and permanent or temporary? Okay. So what happens now? So what happens now is there's no additional compensation expense that gets deducted because all of the vesting happened in 2025. Okay. But what they do get is a tax deduction for the bargain element. All right. And that bargain element is the difference between the stock option and fair market value of those shares. So the bargain element is $25 minus $10 per share, and that's $15 per share, right? And there were 20,000 shares. So 15 times 20,000 equals 300,000. All right. So they get a $300,000 tax deduction in 2026. But that 300,000 is actually two different parts. $200,000 of it is a reversal of the 2024 and 2025 compensation. Okay, so that is a all right, so that's temporary, right? And that would be favorable for that year. The other 100,000 is the excess of the bargain element. Okay, so this is favorable and permanent. Okay, so when those stock options are exercised, you have to pay attention to this bargain element and understand that you're going to have a reversal, and then you're also going to have a permanent part. Okay, and those solutions are also embedded in that PowerPoint for you. All right, so now we're at number 5 on your in-class graded work. Okay, which of the following describes the correct treatment of incentive stock options? All right, and so remember that incentive stock options, right, never have a tax impact. All right, they do have a financial impact, but they do not have a tax impact. All right, and they create an unfavorable permanent book tax difference. Okay, so, and that's incentive stock options. Remember, we just talked about non-qualified stock options in our 2 examples. This is incentive stock options. All right, so now we've got another non-qualified stock option situation here. All right, so now we've got Orange Incorporated, and they issue 28,000 non-qualified stock options valued at $56,000 in total. Okay, the options vest over 2 years, half in 2022 and half in 2023. 1,000 options are exercised in 2023 with a bargain element of each option of $6. What is the 2023 book tax difference associated with the stock options? All right, so we're only concerned with 2023 here, okay? And so what do we know? We know that they issued 28,000 non-qualified stock options valued at $56,000 in total, and the options vest over 2 years, half in 2022 and half in 2023. So in 2023, we're going to have book compensation expense equal to 1/2 of that $56,000, which equals $28,000. So that's book compensation expense. Okay. But then what do we have from a tax perspective? Well, we know 1,000, so tax, we know that 1,000 options were exercised in 2023, and they each had a bargain element of $6. So that's $6,000 of a tax related deduction in 2023. All right, so is this 28,000 is that going to be a favorable or unfavorable situation, right? So this is unfavorable because that's a book deduction and not a tax deduction. This is favorable because it's a tax deduction and not a book deduction. So all totaled, what is our end position for 2023? Well, we've got 28,000 unfavorable, 6,000 favorable. That leaves us with 22,000 unfavorable. So the answer for that one would be A. So another source of book tax differences are net capital losses, all right? Remember that we're talking about corporations, right? And so whenever we talk about corporations, we assume we're talking about C corporations, or at least entities taxed as C corporations. So there's no current deduction for net capital losses for C corporations, right? But they can carry them back 3 years and carry them forward 5 years, all right? And you have to use those carryover amounts on a FIFO basis, all right? So in the year of the net capital loss, you have an unfavorable temporary book tax difference, because from a book perspective, you get to deduct that in the year of, right? But if you're carrying back or carrying forward, right? Carryover is the same thing as carry forward. All right, then you have a favorable temporary book tax difference. All right, so let's look at our next graded problem. So number 7, Studios reported a net capital loss of $40,000 in year 5. It reported net capital gains of $34,000 in year 4 and $47,000 in year 6. What is the amount and nature of the book tax difference in year 6 related to the net capital carryover? So remember, carryover is the same as carry forward. All right, so we are only concerned with the year 6 and only the amount related to the net capital carryover. All right, so what do we know? All right, so we know that it had capital gains in year 4, and then it's got a capital loss in year 5, okay? So it's going to carry back $34,000 to year 4. All right. And so they're going to have to amend year 4's return. That's how that will happen, right? They get this capital loss in year 5, and they go, hey, wait, we could carry that back and amend our year 4 return and essentially net to zero that $34,000 of gain. All right. So they're going to carry back $34,000 of that loss to year 4. Okay. But they still have $6,000 of net capital loss to carry over to year 6, all right? So when they carry the $6,000 of net capital loss forward to year 6, it gives them a $6,000 favorable deduction related to that net capital loss. Okay. All right, I'm going to put a big X through this slide because this slide is a duplicate of the next slide, and this slide is very poorly written. So these net operating loss deduction slides are essentially recreations of what you have in your tax-related schedules. And remember, these are from ordinary income. They have nothing to do with capital gains and losses, okay? Remember that corporations do not get a current benefit from a current year net operating loss, all right? And the deductibility of that net operating loss depends on the year that generated it, okay? So prior to 2018, so this is pre-Tax Cuts and Jobs Act, NOLs could be carried back 2 years and forward 20 years, all right? And they could offset up to 100% of taxable income, okay? The Tax Cuts and Jobs Act changed that, all right? So after 2017 and before 2021, they can be carried back 5 years, carried forward indefinitely, and can offset up to 100% of taxable income, okay? Beginning before 2021, okay? Now, they can offset up to 80% of taxable income after, okay, for years beginning before 2018. So essentially, they created a new kind of carve out for the COVID years to benefit corporations, to give corporations the ability to deduct more of their operating losses that were generated during the COVID years. Okay. For net operating losses originating, after 2020, carrybacks are not allowed. NOLs can be carried forward indefinitely, and you can offset up to 80% of taxable income after deducting, okay? Net operating losses must be deducted in FIFO order. We have already talked about that. Corporations can elect to forego the carryback if the carryback is otherwise available. So they can say, we're not going to carry them back, we're just going to carry them forward, okay? And if a corporation carries back a net operating loss, it must carry it back to the earliest carryback year, okay? So it can't say, I would like to carry it back to year 3 instead of year 5 if there's still income back in year 5, okay? Here's a good example. All right, so in this example, we've got, has a net operating loss of $200,000 for the 2024 tax year. It also has a $10,000 net operating loss carryover from 2017. It reported taxable income in 2025 of $200,000 before the NOL deduction. What is their taxable income after that NOL deduction? Okay, so first thing, we got to use them in FIFO order. So we have to use this 2017 net operating loss first. Okay, so for 2025, we started out with $200,000, but in 2017, we had a $10,000 net operating loss, okay? We're allowed to use that 100%, all right? So what we have left now for 2025 is $190,000, okay? Now, so we've used up that NOL, okay? We also have a net operating loss of $200,000 from the 2024 tax year, okay? All right. Now, because of the net operating loss rules, we can deduct that 2024 net operating loss up to 80% of our 2025 taxable income. So 80% of our 2025 taxable income is $152,000. So we can deduct $152,000 of the 2024 net operating loss. Okay. So I'm going to switch colors here. All right. So this whole calculation right here was just to tell us how much we could deduct. So remember that for 2025, we still had, $190,000 of income left. So we can deduct the 2024 NOL, but we can only deduct $152,000 of that 2024 NOL. So what that leaves us with, that leaves us with 2025 taxable income of $38,000, not $35,000. And we still have then $48,000 of that 2024 net operating loss remaining. And this can be carried forward indefinitely. Okay. And again, that solution is embedded in the slides. All right, so that brings us to number 8. All right. So BTW Corporation has taxable income in the current year that can be offset with an NOL carryover from a previous year. What is the nature of the book tax difference created by the net operating loss carryover deduction in the current year? Okay, remember this carryover, right, means carry forward. Okay, so BTW Corporation has taxable income in the current year that can be offset with an NOL carryover from a previous year. What is the nature of the book tax difference created by that net operating loss carryover? Okay, and some of the distractor, or some of the options, I should say, were lopped off. All right, so if we get an NOL carryover from a previous year, okay, that net operating loss was already deducted for book purposes in the previous year. So in the current year, there is no book impact. So as a result, this is going to give us a temporary and favorable book tax difference. The way we know that this is temporary is that it's a carryover from a previous year, right? So we already got to recognize it for book purposes. Now we're getting to recognize it for tax purposes. So essentially we're undoing that previous difference, okay? So this is temporary, and it's definitely favorable in this year. All right. And I'm going to pause here, and I'm going to do charitable contributions in their own in their own video. All right, so that's going to be the end of part 3 right here.